In this video, I'm going to be sharing with you what your financial advisor may not be telling you about retirement. Or maybe your financial advisor is telling you this. This is pretty common, but you're not understanding or you're not wanting to hear what they're saying. And I know that that happens a lot. So I'm going to share with you these things that some financial advisors either don't tell their clients or their clients don't really understand it. And whether or not you use a financial advisor, these are super, super important things to understand because these are things that affect retirement planning. And a lot of people don't realize them. They're things that I didn't necessarily realize when we stumbled into early retirement a really long time ago. And I've learned many of them the hard way. Okay. The first thing is that retirement planning is based on estimates and probabilities using something called Monte Carlo simulation. So it seems like we could do the math and we would know those numbers for certain, but there are so many estimates, well, several estimates that have to go into retirement planning. The big two are how long you're going to live, and the second one is what will be your investment returns during the time frame leading up to retirement and during the time frame that you're retired. Huge estimates because investment returns can vary greatly from decade to decade, year to year, from economic situation to economic situation. And as you may have heard me say here before, the economic environment, what's happening, those big picture macro factors are what really drive our investment returns, not the product we choose or the strategy that we use. So the first thing to realize, or that your financial advisor may not be making clear, is that your retirement planning is based on estimates and probabilities. The next thing that your financial advisor may not be telling you is that assets right now, including stocks and real estate, are still overvalued, and that at some point prices have to return to the norm. Valuations have to return to the norm. Valuations go way up and then they go way down, and they've got to return to that average valuation amount. So right now, as of this recording, they're overvalued. If you see this video a year from now, they may no longer be overvalued, but as of this recording, stocks and real estate are still overvalued relative to history. The next thing your financial advisor may not be telling you, or maybe you just don't believe your financial advisor, but you're probably not hearing this one, is that stocks and bonds don't always move in opposite directions, yet almost all portfolios have bonds as a way to lower portfolio risk, because over the past few decades, when stocks have gone down, bonds have gone up. We got a little taste of this when stocks and bonds went down in unison. Maybe it was about a year and a half ago. And a lot of retirees' portfolios took a hit in both stocks and bonds. The truth is that stocks and bonds aren't always what's called non-correlated, meaning that when stocks go up, that bonds go down. That doesn't always happen. So that's really important to realize, because it can certainly happen again. In fact, I've done another video on this. Throughout history, stocks and bonds have been correlated more than they've been non-correlated. So that's probably not something you're going to hear from your financial advisor. The next thing your financial advisor may not tell you is when interest rates go up, the value of the bonds that you own goes down. That's because investors can get new bonds and earn a higher rate since interest rates have gone up. So bonds are typically used to manage risk, but sometimes bonds go down, and that's why it's really important to consider the macroeconomic factor when you invest, because interest rates will drive the price of your bonds. The next thing your financial advisor may not tell you is that you can do what your financial advisor is doing in about maybe 2 to 4 hours of learning time and about maybe 3 hours a year implementation time. Now, having said this, this totally depends on what type of financial advisor you have. I've gone into detail about that in another video, so make sure you check out my video on the real types of financial advisors that are out there. And this isn't necessarily an evil thing. I've had financial advisors share with me that they've told their clients, you can do this yourself. It won't take you long. And she has clients that are friends of hers, and she feels badly, she shared with me, doing it in a way that they can do themselves. And they've said they really don't want to do it themselves. And that's why I'm not anti-financial advisor. I think everybody has to do what they want to do so that they're happy and they're not stressed out. And sometimes that means using a financial advisor. So there's absolutely nothing wrong with that. I just want to share with you that a lot of people don't realize that investing in the way that a lot of financial advisors invest on their behalf and it's something that can be done in very, very little time and save thousands and thousands of dollars every year. The next thing that your financial advisor may not have told you, and I can almost assure you haven't heard this one. It's sort of my thing that I had this epiphany on one day, and I love sharing it. And it's just that if you can earn an extra $1,700 a month in income outside of your traditional retirement investing, your retirement savings investing, and you could do something like real estate rentals or covered call income, or maybe even a high yield dividend strategy, although that gets a little tricky because dividends they're kind of part of that more traditional investing for retirement savings. But if you really focused on a really nice strategic higher income, dividend income from your stocks and or bonds, or another example might be that you do a side hustle, as we've seen the younger generations do so brilliantly. If you can generate $1,700 a month in income, it's like you've put aside an extra $500,000 of retirement savings if we compare that to a 4% retirement withdrawal. Now, there are a lot of issues such as taxes, and yes, you've got to put in effort to get this other income stream, whereas making a withdrawal is pretty much a no-brainer. But as far as the money, then that $1,700 a month equates to about withdrawing 4% from $500,000. So if you can come up with a way to do that, it's like you've saved another $500,000. And certainly this could be a great strategy for early in retirement when you don't want to make retirement withdrawals. You're concerned about the longevity or how long you might need to be doing it, or you could do it in addition to retirement withdrawals. So just remember, $1,700 a month. Brainstorm ways that you can make that happen. These are things you may have not heard from your financial advisor, and remember, retire certain.